Bonds will provide a better return on your investment than stocks over the next 10 years. I can't believe I just said that. That felt weird, but that's exactly what a well known, high profile investment strategy team is projecting. While you digest that seemingly radical notion, I'll share a word on economic and investment forecasts. They are a staple of financial commentary, but nobody knows the future, so please consider them with a healthy degree of skepticism. That's what I do. But as part of an effort to stay current on financial markets, I do review outlooks and projections. And one really caught my eye recently for a couple reasons. Well, first, it was from Vanguard. This isn't some Johnny come lately making outlandish forecasts as clickbait or hoping to get an invitation to CNBC to defend an absurd projection. Vanguard is the second largest money manager in the world and is generally highly respected. And the second reason it caught my attention is because the 10-year projections are eyebrow raising, you could say. I already gave you the teaser. Bonds expected to outperform stocks over the next 10 years. That'll get you rethinking your investment allocation. But here it is. Vanguard's investment strategy team is projecting U.S. bonds to return 4.3 to 5.3% annualized over the next 10 years, while U.S. stocks are projected to return only 2.8 to 4.8% annualized over that same period. And I guess to be more specific, it's the midpoint of the projected returns that is higher for bonds. Now, this isn't without precedent. Bonds have outperformed stocks over 10-year periods in the past, but it is certainly not the norm. The last time it happened was from 2002 to 2011, when bonds returned 5.8% annualized versus 3.5% for stocks. Now, I also want to highlight the return projections for the sub-asset classes. U.S. Value's expected annualized return of 4.2 to 6.2% is substantially higher than U.S. Growth's expected return of negative 0.4% to positive 1.6%. Now, going outside the U.S., international developed equities are expected to provide returns between 7.3 to 9.3% annually, and emerging markets equities are expected to return 5.2 to 7.2% per year over the next 10 years. I would venture to guess that we all suffer at least a little bit from recency bias when it comes to investing. Recency bias, in a nutshell, is expecting a continuation of what has been happening. But what Vanguard is forecasting is certainly not what has been happening recently. I want to provide some historical context here by sharing the annualized returns over the last 10 years for some of these sub-asset classes. And I'll run through these rapid fire. You'll pick up on the pattern pretty quickly. U.S. equities have had an especially strong run, posting an average annualized return of 12.5% over the past 10 years, which is a lot higher than what Vanguard is projecting over the next 10 years. For international developed equities, the average return was 5.3% over the last 10 years. Again, Vanguard expects that to bump up to a midpoint return of 8.3% in the coming decade. Emerging markets equities posted a relatively low average return of 4%, and that's expected to increase to 6.2% going forward. And finally, U.S. bonds posted a measly return of 2.4% annualized over the past 10 years. Vanguard expects that figure to be doubled in the next 10 years. So what are some takeaways from all this? And I'd say a couple things stand out. First, my advice would be to avoid using recent stock market returns in your financial plan looking forward. Maybe dial back the assumed investment returns a bit. If you were to use the last 10 years of stock market returns in your financial plan, then it's quite possible it'll look very favorable when in reality it may not be. So it may show that you're on the right track for successful retirement, but you may not be. U.S. stocks have had a remarkable run-up in prices in recent years, and as a result, valuation multiples are high. And it does seem unlikely that stocks will continue to return 10% or more per year for the next decade. And secondly, maybe revisit your 401k allocations if you're still working and contributing to a retirement plan. Unless you use a target retirement date fund, I've noticed that 401k allocations tend to be pretty stock heavy, and that's been great in recent years. But there comes a time in everyone's life when the allocation to bonds should probably be increased. That is all for now. Thank you for watching. I'll see you in March.